Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 30th of September. I'm Daniel Lam, your host for the podcast. One of the trickiest times for investors is when there is a quote-unquote regime change. So that usually demands some sort of alteration in investment strategy. Now, holding cash over the last couple of years has been a reasonable proposition, earning over 5% in a virtually risk-free money market fund or cash deposit. But with the Fed beginning its rate-cutting cycle and China stepping up on its stimulus, this change in regime is threatening the proposition of holding cash. So why is that? Well, cash yields, like those on US 1 to 3 month Treasury bills, they tend to follow Fed rates closely. And as markets expect policy rates to decline to below 3% by the middle of 2025, cash yields will likely fall. So for short-term securities, such as cash, this means the same level of yield will no longer be available once the securities mature, and the reinvestment of mature assets will likely return less than before. So this is known as reinvestment risk. And as rates declines, so will cash returns over the coming months. So it is key to address this risk before yields fall. Now, holding on to too much cash weakens long-term wealth preservation as well. Now, outside of the recessionary periods or major financial risk, equities typically outperform cash. Since 1991, global equities have outperformed cash almost 70% of the time on a 12-month rolling basis. Particularly for the US, extended periods of stock market weakness outside of recessions and Fed hiking cycles are very rare. So we believe that a soft landing, which is our base case scenario, is likely to cost those who are over-allocating to cash. Moreover, cash may not be the best portfolio diversifier. In fact, there's a strong case to make for government bonds, especially in times when inflation is subsiding. So cash offers declining returns during Fed easing cycles and does not appreciate during a recession, but government bonds do, and thus provide less protection against losses in riskier assets within the portfolio. With inflation easing, the negative stock-bond correlation, i.e. bonds gaining when equities decline and vice versa, that is likely to reassert itself, allowing bonds to resume their role as portfolio diversifier. Hence, it is important for investors to alter some of the strategy at this critical juncture. So unless they have their own special needs or circumstance, otherwise they should not have an over-allocation to cash and should consider deploying excess cash to invest in risky assets such as stocks and bonds. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.